A lot is projected to change. The Tax Cut Jobs Act is proposed or projected to change in the end of 2025. They're calling it the sunset of the Tax Cut Jobs Act. That means that it goes away. Now, with Trump going into office and, a lot of proposals, there could potentially be some things that are going to continue on, though we only know what we know and we don't know what we don't know. So really what we're looking at with this is if the Tax Cut Jobs Act does sunset and it expires, that means that the top tax bracket now will go to over 37%, you'll go back to the originals. Standard deductions will not be just what they are now, which is a double standard deduction. It will be cut in half. And then the gift tax, or not gift tax, but the gift amount that you're allowed to have there, or the inheritance that your family can receive without having to pay any taxes, will get cut in half also. So as it sits right this second, going to that, Trump's proposing to make the top tax bracket 37% indefinitely. So that's what he's proposing there. He's also proposing the 13.6 million, which that's for 2024, a lifetime estate or gifting is going to be permanent. So there's not going to be any federal tax up to that amount. 2025, that will adjust. And then also something else that's just different that he is proposing is excluding Social Security income from tax. I know a lot of people are excited with that. As far as standard deductions, we don't know. So as it sits right this second, you have a higher standard deduction. So that means sometimes it's hard to itemize or break down what you're doing and writing off a bunch of things such as interest from your mortgage or charitable giving. If the standard deductions are cut in half, that will be able to give you a little bit more opportunity there. But what we're looking at here for 2024, thinking through what you should be doing. Well, something if you are wanting to gift some money and maybe, you're an ultra high net worth person and you're over that 13.6 million amount, you can gift up to $18,000 to somebody without having to report that. So if you're wanting to, you say you're a parent wanting to give some money to your children, you can gift them $18,000. That's from each parent up to that amount without having to report it to the government. So that won't count against that 13.6 million. Maybe you're saying, well, that's a little bit extreme. I don't have that kind of money anyways. That's okay. Maybe you just don't want the government in your back pocket knowing what's going on. You can gift them the $18,000 without having to worry about that. Charitable giving, where are you at with that? If it's something that you are doing, there's some weird things here because you could say, well, you know what, right this second, I've made a lot of money this year. I need to make sure that I'm giving to a charity, reducing my taxable income. You could do that. You could do it all, into just a single charity, or you could give it into a donor advised fund where you could put the money in there in one lump sum and then direct that as you see fit later on. Also, though, if you're sitting here and you're saying, well, you know what, I'm in a pretty low tax bracket this year, maybe I delay my charitable giving to potentially next year or the following year, especially if the Tax Cut Jobs Act does sunset. There might be some opportunity for you to get a little bit more of a write-off because right now the way it sits with the double standard deduction, it's not as much of a write-off if you're gifting to charity. So it's just something to think about and how you would structure that there. Also, when it comes to charitable giving, if you are over the age of 72, you could do the Qualified Charitable Distributions, QCD. That's something that it comes into play where you have the opportunity to gift the RMD that you would be receiving, or if it's not even an RMD, at least you've met the age, you can take out of your IRA. You can actually do a third-party transfer. So you're going to gift it directly to the third party. You're not taking possession of these dollars. That allows you now to not pay taxes on those dollars ever. You're not going to get a deduction for that money, but if you're already gifting to the charity, let's just say that you're gifting them $50,000. Well, if you took $50,000 out of the IRA and then you had to pay the taxes, maybe you're only gifting the charity $40,000. Well, in this scenario, you could actually take the whole 50. You're not going to realize it as income, and it could transfer directly there, tax-free. So that's a benefit and a win-win for everybody. So what else do we have for the rest of 2024? Well, we've got to think through, do you have any unrealized investment losses that you want to assume? So if you have a brokerage account, you can take up to $3,000 in losses each year. Anything over that has to carry over. Now, if you have gains, your gains can offset the losses. A lot of people talk about tax loss harvesting. Now, this is for a whole nother video because we could go on and on about tax loss harvesting and whether it makes sense or not. In your scenario, you need to look at your specific scenario. The problem, though, with people that just want to tax loss harvest, sometimes you have to say, all right, you know what, I'm going to jump out of this. take all of the losses and the gains, put the money on the side because there's the wash sale rule. You've got to make sure that you wait for 31 days before you get it back into the market. So there's a lot of things there that go into play. Sometimes it may not make sense to do the actual tax loss harvest right this second, but if you do have the losses there, you could offset some of those to help you with your taxes. From there, if you have investments in taxable accounts that are subject to the capital gains, that's what we're going to want to factor in there. If you have the gains, potentially, you could have some opportunity to have some losses that would help you there. So it's just depending on what's going on for you. Your RMDs, you've got to figure out, have you taken your required minimum distributions yet? We talked about the qualified charitable distribution as an option for you. But if you have the RMD, you need to make sure that you are doing that because there's a large tax penalty if you do not do that. For inherited accounts, if you inherited an IRA this year, you still have to take that if you inherited the account before 2020. Now, if you have inherited the account after 2020, this is the last year the IRS said, hey, you know what? We've messed this stuff up enough, made it too confusing. You don't have to take the RMD for your account if you inherited it post 2020 this year. Starting in 2025, you will have to start taking that. From there, you want to start factoring in a little bit of next year, what your income's going to look like, how you're going to structure things. If you're looking at Roth conversions, maybe you're in a low income year this year, while the Tax Cut Jobs Act is still here, potentially you do some Roth conversions. Now, be careful with these Roth conversions, though, because sometimes people feel, well, you know what? The tax brackets are going to potentially increase in 2026. I want to knock it all out right this second. That's not always the best case scenario. Sometimes that actually puts you paying more taxes at the end of life because you're jumping into these super high tax brackets that you should be avoiding in those scenarios. So just making sure you're taking all of that into consideration. From there, just really thinking through from the tax perspective and estate planning, what you're doing as far as insurances go. Do you have life insurance policies that you're going to keep, you're going to get rid of? If you're doing those, you're keeping some life insurance policies, making sure that if they're term policies, they're not set to expire. Maybe that's for the sake of, your own self and taking care of you and your family, or maybe it's something that you just had in play for the sake of paying taxes in retirement. Or for inheritance. So all different various things to think about. There's a ton of them. I'm sure there's some that you probably thought of that I did not mention. If so, definitely drop those in the comments to help everybody out.